Hey everyone, welcome to The Explainer. So glad you're here because today we're unpacking something absolutely fascinating at the intersection of logistics and finance. We're diving deep into RXO's first quarter 2026 financial performance. But more than just the earnings, we're looking at these totally unexpected trends shifting beneath the surface of the macroeconomic freight environment right now. We're going to cut through the noise, look straight at the data, and figure out what is actually going on.
Okay, let's dive right into this. Here's our roadmap. First, we'll look at the broader freight market shift. Then we'll break down Q1 by the numbers, explore RXO's strategic growth in AI, check out Wall Street's verdict, and finally, wrap up with their Q2 outlook. Chapter 1, the freight market shift, specifically focusing on supply-side tightening.
All right, check out this number, 16.5%. Despite a period of pretty soft overall demand for shipping, RXO's proprietary Curve report, which tracks the freight market, showed this massive 16.5% year-over-year surge in first quarter truckload spot rates. I mean, that is huge. It's literally the highest reading we've seen since the third quarter of 2021. So you're probably wondering, why exactly are rates spiking if shipper demand is muted? Well, the cause of that spike really comes down to a capacity crunch, and it's being driven by severe cost pressures across the board. We're seeing strict enforcement of federal regulations, plus a continued attrition of carriers just straight up exiting the market. And why are they leaving? Well, it's a perfect storm of rising labor expenses, a higher cost of capital, and climbing insurance premiums and diesel prices. These immense cost pressures have constrained carrier capacity so much that the carriers who stuck around are finally able to start offsetting inflation by raising their rates. Chapter 2, Q1 by the numbers. A mixed bag of misses and beats. Now, just in case you're new to them, RXO is a leading provider of asset-light transportation solutions. That means they don't actually own massive fleets of trucks themselves. Instead, they own the math. They rely heavily on their tech-enabled brokerage operations to connect shippers with carriers. It's a really interesting model built entirely on scale, efficiency, and technology. So looking at their core financials, it's definitely a mixed bag. On the top line, revenue came in at a solid $1.43 billion. While that was flat year over year, it was actually a strong 5.9% beat against the analyst consensus of $1.35 billion. But looking further down, they did report a GAAP net loss of $36 million. And their adjusted EBITDA of $6 million was down significantly from a year ago, slightly missing the $6.13 million estimate. Meanwhile, adjusted earnings per share matched forecasts right on the dot at a loss of 9 cents. But hang on, that $36 million net loss requires a bit of context to see how it fits into the broader narrative. It actually included $9 million in restructuring costs and an $11 million loss related to debt extinguishment. So yeah, there are some one-time accounting hits in there. The real silver lining for RXO here is the operational momentum. Even with the loss, their full truckload volume improved every single month as the first quarter progressed, really taking advantage of those rising spot rates we just talked about. Breaking down where that $1.43 billion actually comes from shows us that truck brokerage is the absolute core of RXO's revenue model, bringing in roughly $1.1 billion. We did see their last mile division decline by about 8%, primarily because of soft demand for big and bulky goods and the impact of some severe weather. But make no mistake, that brokerage segment remains the massive engine driving this whole company. And within that massive brokerage engine, something absolutely critical happened. RXO saw a 500 basis point sequential increase in their truckload spot mix compared to the previous quarter. I really can't emphasize enough how important this is. This shift toward the spot market drove RXO's largest sequential increase in gross profit per load in more than 3 years. It genuinely marks a definitive turning point for their core operations. Chapter 3, Strategic Growth and AI, and how they are positioning for the future. I want to pull this direct quote from CEO Drew Wilkerson, who said, "We're leveraging our scale and asset-light model, and we're deploying agentic AI across the company." You see, management is directly crediting their enhanced execution and new artificial intelligence tools for this positive quarter-over-quarter trajectory. They aren't just passively riding a market wave here, they're actively utilizing AI to maximize efficiency in matching freight. And while they're investing in that tech, they're also heavily securing their foundation. In Q1, RXO secured a massive managed transportation award, worth over $100 million in freight under management. Their late-stage sales pipeline grew by over $200 million. And crucially, they refinanced their 2027 senior notes, pushing that debt maturity all the way out to May 2031. This is huge because it provides incredible financial runway to let their AI and growth strategies fully play out over the next few years. Chapter 4, Wall Street's Verdict, and the divergent analyst opinions out there. So right now, there is a massive $17 gap between the most bullish analyst, that's Wells Fargo at $31, and the most bearish, which is TD Cowen at $14. The consensus average sits right at $21.11. But what's absolutely fascinating is that as of late May 2026, the stock was trading around $25. That means it's actually trading significantly higher than the consensus average target. Investors out there seem a bit more optimistic than the median analyst right now. That being said, recent analyst sentiment is leaning slightly positive as they update their models with these new Q1 numbers. Just in mid-May, Stifel upgraded the stock to a buy with a $22 target. We also saw UBS and Citigroup maintain their targets of $22 and $24 respectively. So, long story short, the analysts are slowly inching their targets up, getting closer to where the market is currently pricing the stock. Chapter 5. The Q2 Outlook. Anticipating a rebound. Looking ahead, they are projecting a massive leap. RXO anticipates their second quarter adjusted EBITDA to land somewhere between $27 million and $37 million. Now remember, Q1 came in at just $6 million. So they are forecasting a totally huge sequential improvement in profit in just a matter of months. So the crucial point is exactly how they get to that $27 to $37 million figure. Well, they expect truckload volume to be basically flat year over year. But because of the structural market shifts and the supply-driven recovery we discussed at the start, they expect gross profit per load to continue increasing sequentially. They even raised their forecast and are now expecting a high single-digit percentage increase in contract rates for the full year, along with a solid rebound in last-mile stops. Which really leads us to the ultimate question you have to ask yourself after reviewing all this data. Is RXO poised for a massive Q2 profit surge amidst this tightening capacity market? Think about it. With their debt restructured, AI successfully deployed, and gross margins on the rise without even needing to rely on volume growth, can this asset-light model fully capitalize on that 16.5% surge in spot rates we are witnessing? The foundation is certainly there, and Q2 is shaping up to be an incredibly consequential quarter for this company. Thanks so much for exploring this data with me today. Keep analyzing, keep learning, and I'll catch you in our next explainer.